Uyon Auge. One handle. Both platforms, X and YouTube. Exakt spilling. Verify it. Because if you're listening to a copycat in this market, it does not just cost you money. It costs you clarity, direction, time. And in a structural market shift, those are not things you get back. Some people came here thinking this was propaganda. They did not leave. Because once you see the raw picture, no hype, no fear, no agenda, you cannot unsee it. Drop 3 words in the comments. John AG here. That is it. It tells me you are paying attention. That is all I need. Now, let's get into it. Let's start with what actually happened inside COMEX registered silver. Registered silver, the metal that is warrant issued and genuinely available for physical delivery, sat at 88.19 million ounces going into the weekend. No inflow, not 1 ounce. The February contract is essentially finished. And what stands out is not just that metal has been draining for months, is that no new metal is coming in to replace what is already left. Eligible silver, the broader vault category not immediately deliverable, dropped another 1.2 million ounces in a single session. So even while registered holds flat, total inventory continues shrinking. Structurally, that matters. Now look at the March contract. Open interest still represents roughly 222 million ounces. Registered silver, 88 million. That is a gap of more than 130 million ounces between what is theoretically owed and what is immediately deliverable. And the roll from March into May? Far too slow. Only 15 million ounces rolled in one day, with just 4 trading days left before March enters settlement. The math does not close cleanly. If that sounds structural, it is. Pull the COMEX vault, report yourself. They are updated daily. Public. Transparent. The ones who actually check the numbers understand why roll pace matters. Now here is where it gets interesting. China was offline all week for Lunar New Year. One of the largest physical demand engines on Earth, effectively dark. Conventional logic said metals would struggle without Chinese participation. Instead, silver was up nearly 9% by Friday. Futures printed 84.57. Gold reclaimed 5,100. Those moves happen with China absent. Pause there. Now ask the only question that matters. What happens when Shanghai reopens? Here is a data point more powerful than any forecast. The largest silver recycling company in Shenzhen was offering the equivalent of $93 per ounce for 9,999 pure silver going into the weekend. $93 physical bid, with exchanges closed. Western futures at 84. Shanghai spot already running around 86. When a Shanghai gold exchange reopens, that premium differential does not disappear quietly. It gets arbitraged. The ones tracking cross-market spreads understand what a $9 physical premium implies. Zoom out. The Silver Institute's structural data confirms this is the 6th consecutive year of silver running a structural deficit. Global mine production, roughly 800 million ounces annually. 2026 projected deficit, approaching 300 million ounces. That is more than 1/3 of total yearly global production. Not a rounding error, a compounding imbalance. For years, paper markets absorbed it using forwards, leases, rehypothecation. But the cracks show up eventually. And we saw one of those cracks recently, when the LBMA, the core of the global silver lending system, experienced a lease rate explosion. Interbank lending inside the hub ceased. Banks had to publicly bid for metal. That is not theory. That is documented. When an informal cushion disappears, price volatility increases because physical reality starts dictating behavior. Howard Marks wrote that cycles turn when credit structures can no longer suppress underlying fundamentals. That is what happens when liquidity meets physics. Now layer in the JP Morgan and China dynamic. China spent years buying dips, conditioned by suppressed prices. Industrial users grew comfortable being structurally short because every pullback used to resolve lower. Then the market shifted. JP Morgan reportedly moved 13 million ounces from registered to eligible, removing it from the deliverable pool. A Chinese industrial attempting to take delivery was effectively told the metal was not available. Short squeeze. China went limit up. Refiners in Latin America confirmed supply was already contracted at higher prices. That is not just price discovery. That is competitive positioning between major financial powers. Silver is not just a metal. It is a pressure point. Now, let me give you the honest counter case. A stronger dollar creates headwinds for dollar-priced metals. The yuan recently strengthened to its highest level since May 2023. A strong yuan can dampen import premiums. Silver's move from 79 to 84 creates short-term profit-taking risk. And deficit projections are still forecasts. Supply responses can change trajectory. These are real variables. Serious capital accounts for them. But here is what forecasts cannot dismiss. LBMA lease stress happened. COMEX inventories are publicly shrinking. Shanghai physical premiums exist. Registered silver is not growing. These are observable facts. Now, think back to 72. When silver dropped into the 70 to 72.60 support zone, sentiment flipped instantly. Everyone turned bearish. Capitulation language everywhere. I told you that zone was structural support. I told you to mark the bullish swing failure pattern. I told you an inverse head and shoulders was forming. Nobody talked about that when fear was loud. Now silver trades 84.60. Same voices flipped bullish. Same speed. Opposite conviction. If sentiment controls your decisions, the market controls you. There's a reason sentiment behaves like that. A declassified 1974 U.S. Embassy cable openly described how large futures markets could suppress physical demand by amplifying volatility and discouraging long-term holders. Flood paper. Amplified dips. Let psychology do the work. You do not force selling. You manufacture fear. When silver hit 72, sentiment did exactly what it was designed to do. The structure never broke. Only the narrative did. Most people arrive skeptical. That is healthy. Then they see what is actually presented. Raw data. No hype. No agenda. Once you learn to read signal instead of noise, you cannot go back. I do not sell signals. I do not sell courses. I do not sell memberships. I show up. That is it. My goal is not to make you dependent on me. It is to make you independent of everyone. Sharp enough that headlines do not shake you. Precise enough that sentiment does not manipulate you. Independent enough that you do not need anyone. Not the crowd, not the news, not even me. That is the objective. Here is the bottom line heading into Tuesday. Shanghai reopens with a physical bid inside China, running roughly $9 above Western futures. COMEX registered silver has not seen a single new ounce enter the deliverable pool. March open interest still dwarfs registered inventory. The roll pace is slow. Gold held above 5,000 with China absent. And the silver market, structurally built for sub-$30 pricing, is operating near triple that level while physical demand remains intact. The unresolved variable. Will March settlement produce delivery demand that cannot be absorbed quietly? Watch the roll pace Monday. Watch the registered figure Tuesday morning. Pull the vault reports yourself. Verify everything. When you verify primary sources, you stop needing commentary. Invest with logic, not hype. OG out.